Hey everybody, my name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm covering disruptive tech stocks for a broad audience of retail and institutional investors across the globe. Today we're going to talk about a company called Palantir. The title of this slide says, Why Palantir Stock Isn't a Buy. Now we want to quantify that a little bit by talking about bullish versus bearish sentiment. So in one of our recent videos, somebody asked, well, you didn't say whether you were bullish or bearish, and that's really a question that we don't like. In the same manner, we don't like questions like, are you a Republican or a Democrat? That requires you to pigeonhole yourself into a corner and then adopt the beliefs of the tribe that you belong to, and that's not how we roll. So we take more of what the famed Los Angeles DJ Tom Likas would say, the Chinese menu approach. So one from column A and one from column B, and that's how we choose what to believe. And when we look at stocks, we take a similar approach. So we say, all right, let's look at the bullish thesis and the bearish thesis. Now, we don't talk a lot about bullish thesis because that's kind of a given. And not only that, but every single pundit out there already covers that. So we focus a lot on the bearish sentiment. And the reason for that is that we manage our own portfolio and we have a limited number of slots that we can fill. Maximum 40, we're currently holding 38 tech stocks. So when you have a portfolio, you're trying to vet thousands of potential candidates. It's similar to when you're a hiring manager. And when you're a hiring manager, when you sit down to do an interview with somebody, you're trying to figure out reasons not to continue that interview. And then you get to sit there for the remaining 25 minutes trying to pass time, because usually after about 5 minutes, you have an idea if this is a worthwhile candidate or not. And if it is, the interview will often last longer than half an hour. So that's kind of the red flag approach, and that's what we take when we look at stocks. So there's 31 AI stocks, and we manage a disruptive tech portfolio. AI is one component of 12 different categories in that portfolio. So we're looking to hold about, let's say, maximum 6 AI stocks. So when we were looking at available stocks to fill, let's say, the enterprise AI niche, 2 companies that were shortlisted candidates were C3 versus Palantir. We ended up choosing C3. Today we're going to talk about why we didn't choose Palantir. Now, the reason we're covering this firm is because we've had a lot of interest from readers and subscribers about it, and we've written extensively about Palantir over the years. Since, 6 years ago we first started looking at the firm. It's very interesting. What they were doing was quite secretive. And then when they finally had their IPO, we made the decision not to invest in them, and that largely surrounds their roots. Palantir was founded in 2003. They started building software for the intelligence community in the US, and that's kind of how they moved forward. And today, I think in 2021, 58% of revenues came from governments, and it's difficult to say the percentage of that category that's US government, but you can be sure that based on what the company tells us, their intent is to grow their business with the US government, and we're going to talk a little bit about that. Now, one of the reasons that we don't like to invest in companies that have a great deal of business with the US government is because at any given time, things can change. And a perfect example of that was the February earnings that were reported. And here you can see a classic article from Seeking Alpha, buy ahead of upcoming earnings. And that wouldn't have been a good thing to do because shares of Palantir fell around 16% when they reported their earnings. And this is ARK's commentary, and a lot of people look at what ARK does, and if you try to mimic the actions of a large active investment manager, you're going to have a really tough life. So we don't pay much attention to what ARK does, but what they say here is interesting. They say Palantir reported a significant deceleration in growth in the larger government division, suggesting perhaps a change in government procurement behavior. Well, we're one election away from Palantir's relationship with the U.S. government deteriorating. So, and that's especially a concern when the founder, the current CEO, is quite political. So more on that in a bit, but when we look at their latest 10K, let's say their investor deck surrounding the annual report, this is a look at their total customer account growth between fiscal 2020 and 2021. There's some great growth there, as you can see on the left. This metric, it's a SaaS metric, net dollar retention rate. You always want to see that high, 120% or more. And that shows that existing customers are spending more. So they're using the platform, they say, wow, this thing is great. And they want to spend more money on it because it adds value. The right-hand side here, you can see commercial customer count. This is very important because Palantir has a strong reliance on government. We want to see that diversified more into commercial. So you could see here that their commercial customer count was quite strong from 49 to 147. And also along the bottom there, you could see that commercial revenue growth year over year was quite strong. Now, what Palantir lacks is a nice, let's say, these nice revenue buckets. This is an example taken from another AI company. They don't want to be called an AI company, but Schrodinger. So this is how they classify their customers in terms of spend over time, and that's extremely useful in seeing how customers are progressing in terms of the usefulness they find on Schrodinger's platform. Now, unfortunately, we don't get a similar look. So Palantir uses some funky metrics. They're not typical SaaS metrics. So for example, they have this concept of acquire, where they do short-term pilots and operate accounts at a loss. Then they take them to the expand phase, and that's where the customer is spending meaningful money, more than $100,000 in a calendar year, but the account doesn't have a positive contribution margin. In other words, that client isn't profitable. And then when they get to scale, that's when they have a client spending meaningful money and the account is profitable. But then they tell us, well, customers may move back and forth through phases. Well, that's not very useful. And when you read this section of the 10K, it doesn't provide a whole lot of value, so it's quite arbitrary. Now, when we look at customer concentration risk, that's something we always consider. You can see here the top 3 customers for Palantir in 2021 were 18% of total revenues. That's down from 25% in 2020. That's great. We want to see that number decreasing over time. Now, going back to that concern that we had around government versus commercial. So this is the breakdown between those two categories for 2021. And you can see that government isn't classified whether it's US government or not. So then what you can do is take this bottom table here and you can kind of try to deduce things. So you can say, well, you've got the United Kingdom there and France. Potentially if they're involved with other governments, because they tell us the government bucket is, let's say, US allies, then potentially that spend coming from UK and France might be in the government bucket. But we're not told much about that government bucket. We're also not told much. The way they look at government is that potentially within the United States government, you can have multiple different clients. So different departments, things like that. So it's quite opaque. And that's another downside of when you have a company working with the government, is they can't tell you a lot because it's on a need-to-know basis, that sort of thing. So this is a good idea of geographical diversification. They have some good bits there. And then ideally, we'd like to see government decrease over time. We think that's a risk. And you can see here noted something. For example, the U.S. federal government's prohibited from exercising contract options more than 1 year in advance. When they sit down at the negotiating table, they're the big swinging dick. They can decide everything about the terms, and they can decide what they want to do at any given time, and there's nothing you can do about it. So that's a concern when it comes to Palantir. Now, there's also a concern around the politics that this company plays. And if you go to their website, the CEO writes some letters, and there's 2 here that I've noted. The one on the right, the 2022 annual letter, I tried to read it, and I honestly, I'm no Rhodes Scholar, but I couldn't understand what the guy was saying. This other one, this recent March 10th, 2022 In Defense of Europe, the first sentence, I don't get what he's trying to say. The facts of history have always been inconvenient for those whose convictions about its purported arc are strongest, and it goes downhill from there. And at the end he says, but we need an allied technology industry in Europe to step up and fight this battle in order to win. We don't want to hear what this guy has to say about current events, geopolitical turmoil in Europe. It's completely irrelevant to our interest of what he ought to be doing, which is focusing on running the company. So that's a concern that is also mimicked, for example, by Palantir talking about how And this is it starts to become a delicate topic that they're very pro-U.S. Well, as an American, I'm pro-U.S. as well, but they start to say things like, well, our leadership believes that working with the Chinese Communist Party is inconsistent with the culture and mission. Okay, that's fair enough. Maybe you didn't need to say that, but you could have just taken those actions, but the fact that you put that in the 10K means that it's now out there. But then you read in that same 10K, well, IBM's supplying a new product leveraging certain components of Foundry. That's one of their software applications. It's integrated with IBM's Cloud Pak for data. Well, look on the right here. I just pulled this up from IBM's website, and it's IBM talking about their journey of growth with China. In the last 30 years, they have more than 30 branch offices across China, and they're an integral part to IBM's business growth and expansion strategy. So there's a conflict of interest there, right? This is where things can potentially become problematic, and I don't know if anybody's really thought that through. On that similar note, the one thing we're not going to talk about in this presentation is what Palantir does. And I know that a fair number of you have asked questions around that. And I think if you go into the 10K, which is quite approachable, and look in the summary section, they do a very good job describing what their components do, the three primary software components that they offer. Apollo is the third one. That was just made available last year. So that isn't that important because customers vote with their wallets, and we'll talk about that in a second. Now, the other red flag or thing that we found rather odd is this approach they took to invest in SPACs, and then the money that they've given the SPACs, presumably then the SPAC pays that back to them, and it's rather an odd arrangement. It kind of smells like a little Ginkgo Bioworks action there, but it is what it is, and they've invested in. This is just a list of the 2021 SPACs, and it's not comprehensive, but you can see they've invested about $326 million. And we've written a piece specifically about this. I'll put it in the description of this video, a link to that piece along with all the other Palantir research we've published. And in the piece, we looked at how this represents potentially upwards of $500 million in revenue spend, and the fact that the real problem here is that, and people will say, well, maybe some of these SPACs are successful. We're not paying that management team to speculate on which SPACs will be successful. And by holding equity, that's kind of what they're doing. And it hasn't been going overly well. So we've covered SPACs for a long time. And in our tech stock catalog, we have about 99 SPACs. A third of those are 50% or below the offer price. And you can see here that a large number of the SPACs that Palantir's holding are underwater. Now you can say appropriately that, with $2.2 billion in cash, this holding isn't that relevant, and that's true. But the fact that they took this approach seems to be a bit concerning. And then you also have the gold on the balance sheet. And again, it's similar to perhaps the worst example would be MicroStrategy and their CEO who does nothing but go around talking about Bitcoin when he has a software company to run that is declining in revenues every year. It's not their job to be speculating on alternative asset classes or SPACs. So the fact that they're choosing to do that is a distraction, and it's somewhat of a concern. Now, when you look at the valuation of Palantir today, when they had their IPO, they were valued at about $20 billion. Today, they're valued at around 24. So that's not so bad. September of 2020, that's what the direct offering came out at a valuation of 20. Today, it's 24. What we can then do is look at their current market cap and then divide that by annualized revenues. We call this the simple valuation ratio. And in our tech stock catalog, we have a catalog available for subscribers that has about 420 plus tech stocks in it, and I just filtered on a few of these that are similar in terms of how you might categorize Palantir. And you can see that they're valued roughly the same as Samsara. Snowflake has always been incredibly overvalued for whatever reason, and that some of these other firms are certainly valued less. But I guess the takeaway here is that you wouldn't consider them to be excessively overvalued. They're right around their peers. Perhaps, right? If you wanted to say, well, C3 is at an 8, well, It just depends, because the next time that they report earnings, this valuation ratio changes again, and the stock price moves up and down, and it's quite volatile because there's a lot of interest in it. Now, what we like about this firm is this notion of gross margin strength. So if you look at, well, I guess there's two things to look at here. First of all, the revenue growth is phenomenal, and we always look at revenue growth. If you're a disruptive tech company, revenue growth is not optional. You have to be capturing market share, and that's what they're doing here, and they're doing a great job of it. Existing customers are spending more, and you can see here the gross profit. So we always hesitate to use any terminology, accounting terminology or anything. Margin we can probably all understand, but gross margin is simply the revenue minus the cost of goods sold, and that gives you a gross profit. Then you've got overhead that you need to deal with, and the idea is that when cost cutting happens, then you can start reducing overhead, right? You got your general and admin. R&D is something that you probably don't want to reduce, but maybe you reduce, you cut the bottom 10% of your sales and marketing team, whatnot. So, over time, you can reduce your operating expenses. As you start to mature as a company, these come down, and then you start to become profitable. And it's easy to see a path towards profitability. For example, here at the bottom, we put total stock-based compensation expense for 2021. If you back that out, they're profitable, right? And of course, you have to pay your employees something, but the fact is that it's easy to see a path towards profitability for this company if times get tough. As we said earlier, $2.2 billion in cash, that's a decent amount of money that will take them through whatever losses they're running. And also note this total stock-based compensation, that isn't affecting cash. And this stuff can start to become quite confusing. We like to keep things extremely simple. So, Palantir, it has some attractive elements to it, but some of the things going on with that firm just seem to be red flags, and a bit more risk. As risk-averse investors that we are, seem to be more risk than we like to take. So their political pandering is potentially problematic. So what happens when we have a new administration and they don't get along, or what happens with that IBM relationship if somebody points out that, well, IBM's doing business with China, and these things are very delicate, and the CEO's propensity to write letters about things that we can't understand as investors, that makes things difficult. So whilst revenue growth and their gross margins are very impressive, we think that the unorthodox leadership right now is quite risky, and this isn't a firm that we would be investing in. Going back to that earlier comment about AI stocks, we're already holding, I think, 6 AI stocks right now. Palantir isn't one of them. If that number reduced and we were going to vet available candidates in much the same way a hiring manager does, we may relook at this firm. As it is right now, it probably would not be finding a place in our portfolio, regardless of how richly valued it is or how strong the revenue growth is, because we don't like to invest in companies that show us red flags. So that's about it. Please put your comments in the comments section. Make sure to subscribe to our channel, and thank you so much for taking the time to watch this video.